Friends, good evening. This is Deepak Jasani talking to you on 10th of July at about 7 p.m. Modi government's first budget is out. So what is the first reaction? Let's take first things first. As we had said in our pre-budget note, budget is not the be-all and end-all of policy matters. The FM had less than 50 days to prepare his maiden budget, and the problems of low growth and high inflation cannot be whisked away in a hurry. So now let's look at the positives of the budget. The FM has done well to lay out a plan for aggressive reduction in the subsidies over the next 3 years. He has set out plans to form new high education and medical institutions. He has encouraged renewable energy sector. He has increased the income tax exemption limit, the limit on housing loan interests, and also the limit on ATC, which will all lead to more amount of money in the hands of the consumer. He has also minimized the tinkering of the direct tax provisions. Now what are we missing in this budget, or what could the FM have done to assure the people at large about the broad macroeconomic growth in the country? At the outset, one wonders as to how different is this budget from any UPA budget. The FM could have made more efforts to rationalize the expenditure, including consolidate a plethora of schemes. In fact, he has in this budget allocated sums to quite a few number of new schemes. He could have given a vision statement as to how he plans to cut subsidies over the next few years. He should have given a clear deadline or commitment about the implementation of GST and DTC. He could have laid out a long-term plan to control the burgeoning interest payments. He could have given a statement of intent on PSU divestment and their restructuring. He could have formed lesser committees and commissions and instead implemented recommendations of the earlier committees and commissions. He should have given more focus on the banking and power sector, their current problems, and how he intends to solve them. He should have announced intent to reduce the dependence on foreign borrowings. He should have avoided discouraging debt funds, as the benefit of these steps on the PSU banks is not yet clear at this point of time. He should have explained the basis on which service tax collections are expected to grow by 31% in this year, when there is no rate increase or where the additional services under the tax net are not many. And he should have highlighted concrete steps to kickstart the investment cycle. The markets have sold off intraday from the high levels as realization dawned on the investors and traders about the actual impact of the budget. High expectations are the bane of this government, as is also clear from the reaction to the railway budget. While one is disappointed that the new government could have done much more in line with their earlier pronouncements, we can now onwards measure the government on a clean slate going forward. As far as the markets are concerned, they may seek lower levels in the near term, not just because of this budget, but also due to the global factors or the monsoon concerns. But we think that all is not lost, and individual baby steps taken by this government over the next few months could again excite the market participants going forward. Thank you.